the seasonally adjusted Kagiso PMI recorded a second consecutive monthly increase during September, gaining 4 points to move back above the key 50 index point mark to reach 50.7. Joining us in studio now for more insight is Abdul Davids, Head of Research at Kagiso Asset Management. Thanks so much for joining us this afternoon, Abdul. Well, we've got, as I say, this coming as a welcome surprise, the index moving back above the 50 mark, where analysts were watching out for signs of heightened pessimism. A good thing that we're seeing here, because of course that 50 mark separates contraction from expansion.
That's exactly right, and thank you very much again. I think if you look at the trend as well over the last 2 months, we've seen a recovery in August, up about 2 points, and now another 4-point increase, back above the 50 level. Also, if you look at the expected business conditions, one of the key indices, sub-indices of the PMI, a strong recovery there on that side as well. Business activity has recovered very strongly, up 7 points. So clearly, the manufacturing sector seems to be holding up reasonably well compared to the lows of July. I think one of the key factors that we can maybe explore a bit further is the weakening of the rand that we've seen as well. Clearly, that has impacted quite positively on our manufacturing sector as well.
And given that, and given the fact that if you're looking at a factor like the weakening of the rand and how volatile, that movement and fluctuation is, does it mean that we're necessarily on the right track here? Because sustainability of a trend like this is always the big issue, especially where we've got a trend in South Africa going against what is the global trend right now.
Yeah, I think there are a couple of issues there. Firstly, in July, we saw massive contraction in our PMI, particularly because of the disruptions from the strikes, etc. So the decline from, say, June to July was massive. So for the last 2 months, we've been playing catch-up in terms of recovery. We actually expected a slightly stronger recovery in August. That was only 2 points. So the current recovery should really be seen in that context of the massive decline that we saw in the July number coming through. Having said that, we've seen some of the other global PMI numbers coming through, fairly modest, but still growing numbers as well. The China PMI, even the US one has improved quite strongly over the last 2 months as well. I think the concern is that a third of our manufacturing base is exported to Europe. And European PMIs are still lagging, they're contracting, they're fairly weak. And that's probably one of the negative indicators for us going forward over the next couple of months. And that is borne out by the leading indicator, a ratio that we typically look at, the new sales orders versus the inventories. And that is still at sort of mid-2009 lows. So I think there are good parts and obviously bad parts as well.
Let's go into that ratio, because it's a ratio between sales orders and then inventories, and it shows that South Africa remains relatively depressed in the foreseeable future, and that despite the fact that we've got expected business conditions arising. So why that kind of discrepancy that we're seeing there?
I think if one looks at the ratio, whilst it being a leading indicator, is clearly also coincident in nature, because it looks at actual inventories right now. So inventories are building, which is a sign of building capacity and the fact that we're not utilizing our capacity as effectively as we should. Whereas the expected business conditions index is much more about sentiment. And if one looks at the biggest driver of sentiment at the moment, it is the currency, unfortunately, or fortunately, which way you start on the fence of. If we look at the averages in July, we were below 7 rand. In August, we were about 707. In September, 7.50. Right now, we're sitting at over 8 rand in terms of the currency. And I think the entire manufacturing sector, given the fact that a substantial portion of our manufacturing base is geared towards exports, that obviously is a good indicator for them. On the flip side, clearly our imports will be more expensive. So those sectors that are reliant on imports will be impacted by that. But I think on balance, we are clearly weighted more towards a sector that is geared for exports, and a weaker currency is benefiting that sector as well.
All of that, though, not translating into a rise in the employment index. So let's run through the concerns around that, because we've had that employment index remain stuck at depressed levels, and this in a context where overall economic growth is dependent on a jobless recovery.
Unfortunately, that is very true, and one of the key issues that we have, and we've been grappling for the last couple of years with this, I think if you had to go back more than 2 years for the employment index to have been positive, is the fact that firstly, our environment is not conducive for job creation. We've had fairly high wage settlements in the aftermath of the strike season, and that clearly is a trade-off between high wage settlements and job creation on the other hand. Also, we, as I've said, as borne out by the inventory number, we still have excess capacity in our manufacturing sector. So there's no real need, I think, from an employment point of view to hire more labor, because we're still building up to that excess capacity. A lot of our sectors, for example, I think overall capacity utilization is sitting between 70 and 73%. clearly you want that number to be above 80% to see meaningful impact in terms of employment and job creation in the future as well. So those are the key issues that we're grappling with. Fairly almost inflexible wage sort of scenario, and then also the excess capacity in our industry as well.
So in terms of your outlook moving forward then, Abdul, I mean, what's the scenario building up for as we, head into the final quarter of this year and wrap this year up?
I think, unfortunately, I don't want to be the bearer of bad news, but we have seen the trends, and what we typically look at is the 3-month averages. First quarter this year, or middle quarter this year, or second quarter this year, when I say middle quarter, we had an average of about 55. Third quarter, we're looking at about 47 as the average for the PMI for the last 3 months. So clearly the trend is still on a slowdown mode. The rand recovery or rand weakness will obviously boost that going forward. But overall, as I said, with weak inventory numbers, inventory still building, the actual business conditions in terms of new sales orders still below the 50 level, and also the employment index below the 50 level. Also in an environment where we've got significant global concerns around Europe, the debt situation, the global economy seems to be slowing down quite significantly. Unfortunately, the last 2 months have been about recovery. So we've almost been an island in terms of the recovery that we've seen. But I think the reality will hit us probably late in the year in terms of the October and even the November numbers coming through, in terms of our numbers probably hopefully stabilizing above 50, but probably not growing as fast as we would like.
Of course, there's lots of debate right now on whether or not we should see a rate cut come to the fore. Do you see a 50 basis point cut offering the sector any relief moving forward, not only in terms of cost implications for business, but in the fact that a rate cut would decrease the carry trade appeal for the rand, for example, and possibly lead to weakness down the road?
Yeah, I think clearly the sector would benefit usually from a rate cut. That is obviously almost goes without saying. One of the big issues is that carry trade that you mentioned. Yeah. I think a 50 points cut is not going to diminish the attractiveness of the carry trade. And whilst we have seen the rand weakening, and I think the Monetary Policy Committee has mentioned the fact that the rand weakness has impacted heavily in terms of their decision making, I don't think that that should be seen in isolation. I think inflation, whilst we have seen inflation starting to pick up, especially with our imported inflation numbers coming through, I think overall demand is still very weak. So we can almost justify a rate cut on the basis that the economy is still sluggish, it's still a recovery from the July aftermath, etc. So there's huge potential, I think, for a rate cut, and that will boost the manufacturing sector as well.
Abdul, let's leave it there. Thanks so much for your time this afternoon. Of course, Abdul Davids, Head of Research at Kagiso Asset Management, joining us in studio for a change as opposed to from our studios in Cape Town.